Hey everybody, hope everyone's doing well. This is the Emini overview for Thursday, September 5th, 2024. So if we look at the daily chart first, here's yesterday. We had a doji after the big bear breakout bar. Now, I mentioned that the problem with the breakout bar is the context. We had this decent rally and then one, two, three pushes down, expanding triangle, possible bull flag. The bulls are hoping this is just a minor reversal. We test a little lower, maybe find buyers below, and then rally to at least above this trading range, if not a new high. But the problem is, in either case, the upside is probably limited. I mean, just look at the chart. Big up, big down, big up. You can see the bulls are finding resistance up here in this area. They're having a hard time getting past. Really, they're not getting past 5,700 at this point. So even if we do get up here, probably more sellers above, and especially if we go to a new high. But the expectation, I thought coming into today, we had this big outside down bar and then a follow through bar, and it's minimum follow through. The bears prevented a bull body, but it's really the minimum follow through. It's really just a trading range bar. So you could also see it as a big breakout bar, but disappointing follow through. Because of that, the ideal follow through bar would be another bar, just like Tuesday, where there's basically a duplicate bar and the market's all the way down here, like kind of like this bar followed by this bar, a good follow through bar. But instead, we went sideways. And it's a trading range bar, so again, with all trading ranges, the expectation is buyers below, sellers above. So there's probably sellers above yesterday's high and buyers below yesterday's low. And on the 5 minute, you can see coming into the day, we had a lot of overlap. We had a trading range at the end of yesterday. You can call it a bear channel. We were still getting lower highs, even here, high, lower high, and lower lows along the way. But at this point, there's a lot of overlap. The market's getting a higher high from here. It's a possible expanding triangle. And we had an IOI, bar 3, 4, and 5. But when you get an IOI, sort of in the middle of a trading range, it's, Al says it's meaningless. The point is, it's really not. If an IOI is a breakout mode pattern or a reversal pattern, but you're in the middle of a trading range, then it's really not reversing anything. And to bet on a breakout in the middle of a trading range is also a low probability bet. So just because there's an IOI doesn't mean there's an imminent successful breakout coming. And just look at all the overlap from bar 1 to bar 6. Pretty much all the bars overlapping, big tails, inside bars, outside bars. It's just trading range behavior. Now we do have this rally from the low of 69 yesterday to the high of bar 77. That's a strong enough leg up that the expectation was at least a second leg. Got a deep pullback, and now we have a second leg. But the second leg from the low of 81 to the high of bar 4 was also a fair distance, and the first reversal down will probably fail. You can see we fell below 3, but we're reversing up. We may have to go a little bit higher before we find sellers, and it's possible we come up here, maybe test the stop order, sell the bar 38 low. So that's a possible resistance area. Probably sellers in that area. Another one would be the bar 19 low. 19 was a bad stop order sell signal bar, but it worked. Then you can see there's a brief opportunity for bulls if they bought to exit on 21, but it's a very brief window. The reality is a lot of traders got trapped here. They never had a chance to get out of break even. So that is another price traders are looking at. And here is yesterday's low. I'll draw that in blue. And I'm just going to draw the open of the day in green. I think it's useful to look at the keep the open of the day in mind, especially on trading range days. That's typically an important price because the bulls and bears are fighting over control of the bar and over control of the close of the bar. So we got a breakout on bar 8, and then we got bar 7, we got a breakout. 8, bad follow through, but is bar 8 going to reverse this rally? Probably not. It's a weak reversal bar, basically a doji. The rally from the low of 4 to the high of bar 8, strong enough for its own second leg. The risk for the bulls here is you're buying high in a trading range, and it's a late leg, 1, 2, or you could even say it's leg 3. Maybe the 66 high was the first push. So it's a bull breakout attempt of a bull channel. So 25% chance we get a bull breakout of a bull channel and rally in an even stronger trend. 75% chance you get the bear breakout. Always remember, bull channel means bear flag, and bear channel means bull flag. And then 9, we had a decent breakout bar. There's not a lot of overlap with bar 9 and the prior bar. You can see only maybe 20% of the bar, or even less, is overlapping the prior bar. So that's a decent breakout. The problem, though, is bar 9 is completely above the moving average. So what we could have is a bull breakout and then a vacuum test of support. Maybe we're testing the IOI I mentioned here. Some traders might sell, betting the breakout will fail. They get trapped. We come back down to that price. This becomes support. Trap traders, bulls who didn't buy here, trapped out of a good long. Bears who sold here, trapped into a bad short. And that leads to an imbalance. Bulls and bears looking to buy in this area. So as strong as bar 9 looks, and even though 9 is strong enough for a second leg down, because it's a trading range, we could get a deep pullback. And remember, this rally might be strong enough for at least another leg up. So then we got a good reversal bar on 10, and the market rallied. But look at bars 11 and 12. 10 and 11, a good pair of bull bars. But 11 did not close above the prior swing high here. And then 12, we rallied above to a higher high, but then could not close above. And 12 is disappointing. The bulls. So bar 10, even though it's a trend bar, really not breaking out. If anything, bar 10's a bear breakout bar. Broke out below the low of the prior bar. But then we got a bull breakout 11, but then no follow through. And then also ask yourself, what's bar 11 breaking out of? Well, it's really only breaking out of 2 bars to the left. It's really within an overall trading range. And what's the leg count on bar 11? You can see it might be a late leg. I had this channel drawn. So, maybe it's 1, 2, 3. So a disappointing bar for the bulls. For the bears, it's a double top. The signal bar is decent. The context is good. We're high in a trading range. The odds are if a bear sells below 12, uses a wide stop, and scales in higher, they're probably going to make money. And then a little bit of an endless pullback if you see this as a bear, if you see this as a bull channel, and the rallies are getting pullbacks. We now have a 4-bar micro channel, and we can see the market came close to the low of bar 19, reversed down. And now the risk for the bulls is the trader's equation. Now you have a 4-bar micro channel, and you might be high in a trading range. Bears, what if they sell 15? What are the odds we go here before here? I don't know. Maybe it's 50-50. However, here's twice this measure move. So here's 1 times, here's 2 times. What are the odds we come here before here? I don't know. Maybe that's 40%, but that's 2 to 1, and that's a positive trader's equation. And the reason it's a reasonable sell is because if you judge the strength of the rally, just look at the rally. Look at all the overlapping bars. Here's a rally, but then a very deep pullback, another rally, another deep pullback. All these bars are overlapping. You look to the left, we're high in a trading range, and we know the overall context, the market has been in a bear channel. So here we are in bar 15. So if we draw a trend line, maybe there's an overshoot. Maybe this is the bear trend line. The bulls are attempting to break out of the trend line. I'll just go ahead and draw a parallel too. Maybe right there. Then we got bar 16. So you can see we're testing the open of the day. Possible sell vacuum, test of the open. Maybe it's leg 2, 1, deep pullback, 2. But 15 and 16, that's a pair of good bear bars. Bear breakout bar, little overlap with bar 14, closing well below, and then 16, an even bigger bar. So the bodies are increasing in size from 13 to 14, 15, 16. So there's increasing momentum. It's not very climactic, and there's room to the downside. If this is a trading range, we could easily test down to below yesterday's low. I should have yesterday's high drawn as well. I don't know the exact percentage, but probably something like 90% of bars are breakout bars. If you just look at any chart and just count the number of inside bars are the only non-breakout bar. So most bars break out of the prior bar, and markets are fractal, so that applies to any chart, any time frame. And because of that, if you think about the context with the daily chart, that's why I always mark the prior day's high and low, because there's a really high probability that we break out of at least the high or the low of the prior day. So at this point in the day, is it more likely we're going above the blue line above or below this blue line, the low of yesterday? Probably more likely we're going down here. The bulls have had a couple of attempts to the upside. We have a double top, micro double top here, double top over here, or over here, and then good momentum to the downside. So bears getting follow through. Bad high 1, probably sellers above. We went outside down, and even more follow through 19. You can see 19, we fell below the low of yesterday, and there was profit taking. But just because there was profit taking does not mean there's enough reason to buy. This is too strong. There's no reason to buy. We have not had a bull bar in about 8 bars. So even though we might be low in a trading range, this breakout is all just one leg, and there's a high probability that we get some sort of pullback and then at least a second leg down. 19 is a bad stop order buy signal bar. Even though it closed above its midpoint, it's a buy reversal bar, but there's probably more sellers above. And then we paused, another bear breakout, another pause. So it's possibly of a sell climax, pause, sell climax, pause, and then maybe one more sell climax and pause. So now we have 3 legs down, but the channel is very tight. Whenever the channel is tight, you should not be looking for wedge bottoms. When the channel is tight, in this case a bear channel, you should only be looking to sell. Even if you've had 3 pushes and it's a parabolic wedge and the expectation is a minor reversal, the market's still always in short. Maybe you can buy down here for a scalp, But bears who sell here use a wide stop and scale in higher, they're probably going to make money. And then we have a low one. So we have 3 pushes down and a low one with a bull body on 26, probably buyers below for a scalp. And we went sideways. Trying to go lower, we break out to a new low on 30 and then 31 reversed up. Is 31 a major trend reversal setup? No. There's just not enough bars. There's not a trend line break, or at least not a significant trend line break. You could argue there's a trend line break. The market went sideways, but it's only about 5 bars. So the bulls have done a good job making the market go sideways for 5 or 6 bars. But the bulls really, ideally, they'll get a breakout that's more up than sideways. They want to see a surge in momentum to the upside, at least breaking the moving average, and ideally getting a bar completely above the moving average. And if they can do that, you've heard Al talk about the 20 gap bar. Typically, that becomes the final pullback before you get a retest of the trend's extreme and then an attempt at a major trend reversal. But most major trend reversals lead to trading ranges. Only about 40% lead to opposite trends, no matter how good the setup looks. So 31, it's a minor reversal. You might have traders buying above 31, taking a chance we just vacuum up and test the moving average or maybe a breakout point. But if they have a weak entry bar, they'll just give up on the trade. And then 32 triggered that stop order, but did not close above the prior bar. Maybe 80% of this bar overlaps the prior bar. That's fairly disappointing. It also could be leg 2 in a trading range in a bear trend. So this is a bear flag. Leg 1 from the 25 low to the 26 high. Deep pullback, leg 2. This also subdivided into 2 legs. So bar 31 rallied, pulled back into the close. We sold off a little on 32 and then rallied. So that's 2 legs here and 2 legs here. High in a trading range. So probably sellers in this area. And then 33, 34, we fell to a new low, but now we have 1, 2, 3 pushes down. The wedge is minor. It's made up of only maybe 10 bars, but there is an expectation of a deeper correction. We could come back and test the moving average. We can get maybe 10 bars and 2 legs, sideways to up here. So bears, they might not look to sell until after that correction. We had consecutive sell climaxes here, and we had 3 pushes down here. So bears are taking profits at new lows, and bulls are buying for scalps. You can see if a bull bought the low of 25 on 30, they would have made money. So the logical thing to do, if it worked here, they'll do the same here. So bulls will buy here for a scalp, bears will take profits, bulls and bears are buying, and then the market reverses back up. 34 through 36, strong enough bull breakout for a second leg up. But this is all still minor. We're completely below the moving average. But the bulls are doing a good job. We're getting a lot of bars sideways. And the momentum for the bears has dried up. So up to 39, this was a bull micro channel. So about 6 bars without a pullback. The expectation is buyers below the first reversal attempt. 39 is a bad stop order signal bar, probably buyers below, and a second leg up. It's also 5 bars, 5 or 6 bars after the wedge. So we'll probably get maybe 4 or 5 more sideways to up. So inside bear bar 40, but micro channel, probably minor reversal. Bad entry bar for the bears. They might wait for a better sell setup. And the bulls who did not buy might buy the first pullback for a second leg. 42, that might be the second leg for the bulls. Leg 1, sideways, leg 2. But 42 is a bad stop order sell. Fairly big bar, bull body, and you're in a trading range. So we're continuing to go more sideways to down here. maybe one leg down to 44, another leg down 46, another leg down 48. So 48 is a good looking bear bar, but what's the leg count? It might be leg 3. 1, 2, 3. Looks like the bears need at least one more bar because 48 is actually not breaking out below 46. So this could be a sell vacuum testing support. And we had, let's back up. 34 was a weak stop order signal bar, but it led to a profitable stop order long trade, and that makes the high of 34 support. So we tested it on 46, we bounced, testing it again, 48, and we bounced. Now we're getting a bigger second leg, so maybe this all was leg 1, maybe a complex 2 or 3 legged pullback, and then a second leg up to bar 50. 51 breaking out to, actually let me back up. So 48, 3 legs down, and then 49 a bull bar closing on its high. And I want to back up and talk about the major trend reversal. So bear trend, and then the market went sideways for at least 20 bars. And whenever a flag in a trend goes on for 20 or more bars, the probability of a breakout becomes about 50-50 in either direction. And so even though this trendline break is more sideways, the bulls were able to break the moving average. There's a good amount of bull bodies in here. The bear bars have tails below, and it's enough sideways to disappoint the bears. So 49 had the potential to be a higher low major trend reversal. So 49 is a reasonable place for bears. Always in bears can exit above 49, and bulls can take a chance that it's a major trend reversal. And that got good follow through. So breakout up to 52. 4 bar breakout. Technically 49 is not breaking out. It only broke out below the prior bar, but 4 consecutive bull bars. It's a really decent looking breakout for the bulls. Probably the biggest problem with this rally is just look at the day. We had a weak rally on the open, then a really strong sell-off. And after we went sideways, the bulls are attempting to maybe get a reversal. Maybe they'll get to maybe a new high of the day. And so far, this breakout looks good. But one problem is it could be a second leg trap. Maybe 34 to 42 was leg 1, pullback, and then a strong second leg, leg 2 in a trading range. So this could be a buy vacuum testing resistance. And what resistance are we testing? The open of the day could be one area, but this is certainly strong enough for a second leg, and the first reversal down is likely to fail, probably buyers below 52. The problem for the bulls is the trader's equation. If you buy the close of 52, put a stop below 49, at this point the market looks good. The momentum looks good, the breakout, there's micro gaps, the bars are fairly uniform in size, closing near their highs. Although it really is a problem that 50 and 52 have prominent tails on top. If this is a strong bull breakout, why are traders selling into the closes of the bars as opposed to, for example, 15, 16 closing near their lows? So the tails are a little suspicious. But let's say you buy the close of 52. Are you 60% sure we're going here before here? I don't know. You look to the left, maybe big up, big down, big up. The market's in a trading range, and breakouts tend to fail. Measured move targets don't get reached. It's probably not 60% we're going here. So if it's not 60% and the theoretical stop goes below 49, you cannot take the trade. It's not a positive trader's equation. Sideways, inside bar, 53. 54. Is 54 the second leg? Leg 1, pause, leg 2? It might be. It's the minimum second leg, but this could all just be part of leg 1, and there could be a more complex pullback and a second leg that's more symmetrical, but the risk is this is a second leg trap. We go to a new swing high, and 55 is disappointing for the bulls. Now we have 4 bars more sideways. You can see 55 tested the open of the day and reversed down. This is still a micro channel, and 55 is a weak stop order sell. It's reasonable for bulls to exit below 55, but for a bear to sell, it's not ideal. The signal bar is not very strong. The momentum is decent. It's a tight bull channel at this point. Technically, it's a spike. So the bears need to see more selling pressure and more sideways. But we are coming close to that bear trend line again. We're going to clean up the chart a little bit and just focus on, let's just keep the open of the day for now. Inside bar, bear bar, so disappointing for the bulls. Where did all the momentum go? The bulls are buying momentum here, and the next 5 bars or more sideways. So the bulls buying momentum, their premise is no longer valid. The market's going sideways. So those bulls, they'll give up on the trade. And if you're buying here, you're not buying value. The market's above the average price. So if you're paying above the average price for really weak momentum in the middle of a trading range, then it's probably not ideal to do that. 58 might have been the second leg. Maybe it's leg 1, pullback. Leg 2, you can see we're testing the close of 54. In this area around the open of the day, there's resistance, and then we fell again, reversed back down on 59. 59 is a more reasonable sell for the bears. The signal bar is good. It's an IOI pattern, so you're looking to reverse this bull leg. Maybe we're high in a trading range where the open of the day might be the top of the range. And again, you're thinking about the bull argument. It's a good breakout, but then we went sideways and the bulls are disappointed. Also for the bears, it's a second entry short. The first one below 56, that triggered, and then a second one below 59. Decent entry bar, 60. It's a bad stop order buy. It's a high 2. Here's a rally, high 1 above 57, high 2, 60. Double bottom with 53, but consecutive bear bars, and the context is just bad for the bulls. You're getting a lot of sideways price action in the middle of a trading range. It's not ideal to buy here. So we rallied above for a couple of bars. The entry bar for the buy is a weak entry bar. We sold off into the close, and then the follow through broke out above, but also closed below. Lots of overlap. It's really a trading range. You can see it's a tight trading range on this chart. If we went down to a smaller time frame, you would see a couple of legs down, maybe a couple of legs up here, resistance above. Low 1 below 62, triggered but failed. High 1 above 63, but a weak buy. We triggered the buy, but probably limited upside. 65 went to new swing high, but disappointing for the bulls. Now we have 2 legs up here, 1, 2, and this might have been the second leg for this. 1, pullback, 2, which subdivided into 2 legs of its own. And then 66, a good entry bar for the bears. That's a low 2 short. It's nested. It's a low 1 below 56, low 2, 65, but also low 1, 62, low 2, 65. Signal bar is not great, but context is decent. But the entry bar was good, so the entry bar makes up for the weak signal bar. And for the bulls, what is there to buy here? You have now consecutive bear bars, 66 being strong, closing on its low. We're probably going at least a little bit lower. 67, attempting to break out below the moving average. It broke below, but did not close below. The bulls, maybe they see a high 3. Bull breakout, 1, 2, 3. Wedge bull flag, they look to buy above 67. But 67 is 3 consecutive bear bars. It's a weak stop order buy. If you buy above 67, you need a good entry bar like 51. There's probably more sellers above 67. It's a 3-bar micro channel. Also, remember what I mentioned over here. Once a pullback grows to 20 or more bars, breakout direction becomes 50-50. So back here, maybe the probability favored more to the upside, but the more bars that get added to this bull flag, the more neutral it becomes. Also, just look at the bars from 53 to 67. There's more bear bars than bull bars. The bull bars have tails on top, so they're really not ideal. The buying pressure is not ideal. Inside bar 68, so we did not trigger the buy. Now we have a 4-bar micro channel, probably going lower. Sellers above, first pullback, probably minor. 69 breaking below the moving average. So where is the market testing? The market found an area of agreement down here. There was a trading range for at least 20 bars. And we broke out of that trading range, but traders found, bears and bulls found this to be a fair value. Most breakouts fail, so we tried to break out. We went sideways. Now we might come back down and test somewhere in this range, maybe the 50%, the midpoint of the range. So that's around here. And that's close to the stop order, 49, so I'll just mark that. Traders were trapped above 49. If a bear sold above 49, trapped into a bad short. If a bull did not buy 49, trapped out of a good long. Traders are trapped below and their support, bears and bulls looking to buy. This breakout is strong enough for a second leg. And while we may have had the second leg here, it's also possible that we get a deep pullback and then a delayed second leg. That's really common in trading ranges. Kind of had a small version of that up here with bars 8 and 9. Strong bear breakout, strong enough for a second leg, but not before a deep pullback to a new high. And then we got a second leg. Sell vacuum 70, we're testing. You can see we came close to the 49 high and started to bounce. Big up, big down. The market's in a trading range. We're getting into the buy zone, so really not ideal to be selling down here, but this is strong enough for a second leg. But remember what I just said, we could easily get a deep pullback before that second leg. And then bull reversal. So similar idea. What I was saying with the lower range, we can look at the upper trading range here. Here's the midpoint. That'll be a magnet. So the market might be racing up, testing somewhere in here. The market found balance, bear breakout, but then a vacuum right back up into that range. Big down, big up. The market is sideways and it's confusing. This was strong enough for a second leg down, but this was strong enough for a second leg up. So even though this is strong enough for a second leg, we may get a deep pullback first, and that deep pullback could be the second leg to this breakout. So 73, good looking bull breakout and follow through, but now you're in the sell zone of a trading range. And then you can see we immediately reversed on 74. And then we sold off. Big down, big up, big down. The bears got their second leg. The bulls got their deep pullback. You can call it a high one above 76, but it is a double bottom. So every double bottom is a high 2, high 1, 71, high 2, 76. Testing support. The market sold off. Tested the high of 49, somewhere in this area. Found support, strong enough breakout for a second leg. Testing it again, probably buyers in this area. And then another breakout to the upside. But the process repeats over again. So big down, big up. Maybe this breakout was strong enough for a second leg down after a deep pullback. Was 77 the second leg? 1, pullback 2. Maybe it was minimum, but it was tight enough. I'm not sure if there was a meaningful enough trend line break there, so maybe we need a deeper pullback in a second leg. And the bulls got their second leg, so rally, deep pullback, second leg. Where's the market? We're testing an area where bulls just got trapped. If you bought the close of 73, you're disappointed. And if you scaled in lower, the market gave you a chance to avoid a loss. Maybe not quite at your original entry, but very close. And then 81 actually did get you to your close of 73 price. And then you can see sellers. For stop order trades today, maybe you can take a chance buying above bar 5. It's a bull bar closing on its high, but really not ideal in the middle of a tight trading range, and especially before bar 7. Bar 7 is often a news report, and the market can be volatility expansion. We can get a sort of a surprising breakout on that bar. So I know that Brad recommends most traders don't trade before the first 6 bars. And then reasonable to sell below bar 12. The signal bar is decent. Context is good. High in a trading range. Double top. You could sell below 15, 16. Always in short, you could sell below any of these bars. But better to sell below a bear bar closing below its midpoint, like 18. You could sell below 21, 23, 24. All reasonable sells. And then through here, maybe you can buy 34, 3 pushes down, expecting a test of the moving average, but that's a scalp. You're not expecting a major reversal. And then through here, the bears see this trading range as a bear flag, so bear trend sideways, and the first test of the moving average in maybe 20 bars, you can sell below 40 or 43. But then 49, I mentioned earlier, was a reasonable buy, so bears will get out above it, and the bulls will buy on a stop above 49. Possible major trend reversal. You could buy the close 50, you could buy above 50, you could buy above 51, buy the close 52. But as soon as the momentum dries up, you can see the bulls use 54 to exit, and we go more sideways to down. I thought 59 was a reasonable sell. 65 was a reasonable sell. 66 probably better. 69 you could sell, but then 70 more of a gift bar. It's a profit taking bar. Sell climax to a buy zone. And then I don't know, you could buy 71, taking a chance. It's a double bottom and we reverse up, but even that is just a scalp. You're not expecting a bull trend after a 6 or 7 bar bear micro channel. Maybe you sell below 74, but even that's not ideal because that could be close to a 50% pullback of this bull breakout, so this could be support. 76 is a more reasonable stop order buy, but again, that's a scalp. You're expecting a retest somewhere high in the trading range, the 73 close, or somewhere up here. But after 2 big bear bars, not ideal. And it's also late in the day, and that's not ideal either. And where do we go tomorrow? So we had the big outside bar, but 3 legs down, and then bad follow through on the bear breakout. It's a spike in channel, and you can see we're testing the high of August 14th. Looks like we tested, let's see, the high is 87.75, the low is 90. We came close to the high of the 14th, and we're bouncing. This rally was strong enough that there's buyers below. So as we work our way lower, we're going to find buyers scaling in. As strong as this bear bar was, the follow through has not been great. But the bears have gotten 2 bars basically completely below the moving average, and that's decent. But overall, this looks like a trading range to me. The market's up, we're down, and we might be low in the range. We've had 2 or 3 legs down. The low of August 30th was a weak stop order sell signal bar. So there's trap traders here. In a trading range, typically if you get trapped, you have a chance to scale in lower and exit and avoid a loss. I also mentioned spike in channel trend for the bears. So now that getting a downside breakout below these bars is getting less likely. Also remember what I said, I'll pull this up on the 15-minute chart. Remember I said channels, bull channel means bear flag, bear channel, bull flag. Market's in a bear channel. And I don't want to confuse anybody. Channels can go on for a long time, but the expectation, eventually, there's a 75% chance we're going to get a bull breakout of this channel and it will convert into a trading range. Less likely, 25% of the time, you get the bear breakout and the market accelerates into an even stronger bear trend. So here's the spike. This is where the pullback was that started the channel. And so this is a target somewhere up here. Spike, channel, and then eventually trading range. I'm just curious, that's to about 55.90. And that's pretty close to that bar, the low of that bar, 55.94, so within 4 points. So that makes sense. All right, thanks everybody for watching. Hope everyone has a good rest of their night.